For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning and welcome to Show Me the Money with Randy and Jake Floyd, the show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name is Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Randy and Jake Floyd, of course, of Floyd Financial Group. I'll start with you. Jake, how you doing this morning, my friend?
I'm doing great, Jeff. Thank you for asking.
You're certainly welcome. And Randy, you're joining the crowd this morning. How's this weekend treating you?
You know, really good. I have had a couple of good bike rides this week, and it's been cool in the morning, believe it or not. 68 earlier this week, so pretty good.
Yeah, well, when it gets really, really hot, I think the early morning and the later evenings are the best time to get out and do things, but nothing really stops you as far as getting that exercise in. Also want to take this opportunity to, again, if anybody hasn't said it, happy birthday, America. 248 years old. Did you guys do anything fun for 4th of July?
Yeah, you know, we had a little get-together and blew some things up.
Like a good American should.
That's right. You know, I'm so surprised, you know, when I drive around my area here, the number of fireworks stands that there are. I mean, there's a fireworks superstore, but almost on like every second or third corner, there's a fireworks store. I can't imagine the firepower that people have stocked up on. But nevertheless, I hope that everybody got through the weekend with all 10 fingers and toes. I've spoken to people in the emergency rooms. Generally, that's a very busy period of time. So we'll let you heal before we get to the next holiday. Anyway, a lot to talk about on today's show. Of course, here we are in July. We are halfway through the year, so we'll talk about that a little bit. But I want to talk about something that came out last Tuesday, and that is the JOLT report. And for those people who do not know what the JOLT report is, what is that?
Yeah, Jeff, so the JOLT report measures, how the general health of the economy is as far as jobs go. And so it talks about how many job openings there are and just general health of the overall jobs market.
And we had the JOLT report, at least the findings coming out last Tuesday. What did they show us?
Yeah, so they show us that the Biden administration still has their finger on the scale in weighing these numbers in because they apparently didn't get the memo that Biden tragically lost the debate by a large margin, and therefore they're looking and scrambling for someone else. However, that aside, the jobs openings numbers were stronger than expected, although they had revised up the previous numbers as well. So you got to take this stuff with a grain of salt. You have to understand that these are not exact numbers. They should be, but they're really not. And these counts, what happens is they come out 1 month, and then a month later they revise those numbers back after they've had a chance to really have more data come in. And then 2 months later they revise it again backwards 2 months. And so, it's a little bit too early to get too excited, but it does seem to be going in the direction that the Fed would want if they were going to cut rates.
Okay, so what you're saying is that we don't put a lot of stock into the JOLT reports or most any other report that comes out of Washington, because as you said, if they can put it out, then they can revise it, then they can revise it again. I mean, what really good is this? What stock should we as consumers put into this JOLT report? How does it really make a difference to us?
So the main thing that the JOLT report is going to do is it's going to influence potentially Fed policy, how the Fed is thinking about interest rates. And so us personally, it really doesn't affect us really at all, but it does show a little bit the overall sentiment shift of what the Fed is thinking based on these reports.
Okay, so that is the JOLT report, or as you say, the JOLTS report. Let's move on to what else is happening here in current events. I understand the New York Times has said that the First Amendment is out of control. That seems to be an interesting statement from a news organization.
You have a crisis in this country when journalists are saying that the First Amendment is out of control. That's crazy. I mean, who would have thought that was ever going to happen? But, I think the First Amendment is pretty clear. You have freedom of speech, and not everybody has to like that speech, right? And Vivek Ramaswamy, actually, who was, one of the few front runners for the Republican Party in the primary, he said the solution to hate speech or bad speech is more speech, not less speech. And I would wholeheartedly agree with that. Let people say what they need to say, what they can say, whatever they will say, and then let's let other people decide whether or not that has any weight to it or any credence, or we should pay attention to that speech. I think clamping off somebody's speech is a very dangerous, slippery road to go down.
Yeah, that's for sure. The other thing I would throw out there, Jeff, is this, that, generally speaking, and this is a general statement, those that blab the most have the least to say, really.
Yeah, I've heard that.
Yeah. So we need to kind of be sure we're thinking about what people are saying. Also, think about the vast majority of people that I think have their opinion and are sitting there keeping it to themselves, but they still vote.
And I would agree the First Amendment's very, very important, and I think that if people do have something to say, they should say it as long as it doesn't hurt anything else. Let's talk about corporate earnings. I understand that the corporate earnings report is going to be coming out soon. What can we expect there?
Yeah, so, Jeff, after the quarters close, it takes some of the companies, are pretty quick to get it done, but generally it's 40, 45 days before the big players come out and actually share earnings with us. And that's always very telling of what's going on as far as the stock market. And it tells us, these companies are doing well. They're meeting their revenue. They're meeting their earnings. And later in the show, we're going to talk more about some things. There's been a lot of comparison of late between 2000 and where we are now, and dot-com bubbles and things like that. But we'll be talking about that later in the show. But the first half of the year has been pretty good. We've had at least the first quarter that was reported. The earnings were pretty strong for the most part, and I don't anticipate there'll be much difference. But the numbers will be coming out, and there's a lot of people predicting where the market is. There's a lot of people saying, well, it's too high. I was reading just a couple of days ago that they're expecting a 28% correction. All sorts of conjecture, if you will. But, we do think that maybe we're in for a period of a little flattening here while we get the country through the presidential election. But, that'll remain to be seen.
As you said, some flattening in the market. Do you think that it could go even further than being flat here for the rest of the year?
Yeah, I think so. Especially, one of the things we probably need to explore is what happens with a Trump victory, which, unless the Democrats come up with somebody else that they can front out there, I just don't see how, after Joe's performance, even the Democrats are reeling. Right. I don't know how he could possibly win, but we need to talk about what happens if Donald Trump does win his second term as president. What do we think is going to happen there? Is we need to explore that probably a little.
Yeah, and we're going to talk about that mostly in the second segment of the show today, so stay tuned for that. Inflation, let's talk about that. Everybody talks about it. Nobody does anything about it. Inflation is really changing our lifestyle and the way that restaurants do business. I had a friend who bought a seafood salad and had some prawns in Hawaii, and it was like $65. That was for one person. We bought a pizza from Domino's the other day, and by the time they delivered it, little medium pizza, it was $45. This is really changing the way that Americans think about eating out and just in general spending money.
Yeah, I would agree, Jeff. And I think the inflation thing, of course, we know COVID, the shutting down of everything, this is all old news. And then the printing and putting all the money into people's hands from extra stipends and things that just came out of left field. And then, of course, the printing and the putting of all that money into the system, $6.5 trillion kind of got sprinkled out there. That has created a situation where people had money to spend. They paid off maybe some of their debt when they got that extra money in. But then we also had corporate America looking at the fact that, wow, this is kind of ugly. We need to hedge our bet here. And I think they got in a position to where they got ahead of inflation in many cases. And now that they're there, they're not quite sure how to give up or how to go into not necessarily a deflationary period, but a disinflationary period. The difference being deflation is, prices are going to go down from where they were maybe, but I think basically we're going to flatten it out from here is what's going to happen. There may be some things that'll go down, but I think it's just going to flatten out from here. And I think inflation is going to get under control, and we've talked about this before, when people decide that they're not willing to pay the price anymore.
Well, so many people can't afford that. I mean, McDonald's these days, if you roll through there, you got a family of four. I mean, I'll roll through and get a drink or something like that. Somebody in front of me who's got an SUV or a van and a family of four. You look at what they spend, it's $60, $70. I can't believe that people are willing to pay that. And, eating out used to be a thing here in at least in recent years. People did it all the time because of the convenience and they could do it. But I think that we're really rolling back to the way it was in the 60s and the early 70s, in which eating out was really just a big treat. Do you find that that's the way we're going, Randy?
Well, I think so, probably. I think it's really got two edges. I think number one is, the cost side of it, but the other side of it is I noticed this about myself and my wife and our, a lot of our immediate family. We have also changed how we eat based on, it's hard to buy and know that you're buying nutritious, well-balanced food from a restaurant. Generally, you're going to get lots of sodium, lots of fat,
Or even if you go to the grocery store, you don't know if you're buying Bill Gates food or if you're buying actual food.
You got to be careful. And so I noticed that we're doing a lot more label reading and we're being a little bit more selective about what we do. And so I think that will also change the restaurant industry. And I think we're probably at a point here or nearing a point to where we're going to see the next metamorphosis of restaurants and the food business in general.
Right, and in your recent trips to restaurants, have you noticed that the portion size, the serving sizes have gotten a lot smaller than they used to be?
Yeah, that reminds me of a story when I took one of my beef farmers to a very elegant restaurant, and basically he said, "Randy, where's the beef?"
Like Clara Peller, where's the beef? For those.
Yeah.
Well, yeah, I'm finding the same thing, too. Whether it's a serving at a restaurant or you get something that's delivered to you, takeout food, almost everywhere the portion sizes are way smaller than they used to be. I think America enjoyed having these super sizes and all that sort of thing, but now we're getting back to reality. And, eating out, as you said, and a lot of these things that we took for granted are now becoming treats, and that may not be a bad thing. We're talking with Randy and Jake Floyd, Floyd Financial Group. We're glad you could join us this week for Show Me the Money. And if you would like to sit down and talk with these two gentlemen about your battle with inflation, your retirement roadmap, maybe you've got a plan, you want a second opinion on that, we're offering you the opportunity to do just that. Get your questions answered by calling Randy and Jake here at Floyd Financial Group. Our telephone number, 417-889-7233. It's 417-889-7233. I know it's the weekend right now, but make that call. Leave your name, your telephone number. Ashley will call you back during the week and set up a time for you to come in and sit down with Randy and Jake. Get your questions answered. So many people say, well, we don't have anybody that we can talk to in the financial services business. Well, that is not true right here in the last bastion of Sanity, Springfield, Missouri. You do with Randy and Jake at Floyd Financial Group. So take advantage of this. There is absolutely no cost whatsoever, no obligation, and no judgment. Again, that telephone number, 417-889-7233. You can also request your appointment and find out more about us online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. We're going to take a break. When we come back, we're going to be talking about a Trump victory. Could it cause more inflation or not? All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about what's kind of been in the news, and that is, if Trump wins, does that mean more inflation?
Yeah, I'm looking at this headline, a Trump victory could fuel more inflation. I really haven't read the story yet, but it seems a little puzzling, so I'm going to turn it over to you. What do you think they mean by this?
Well, I think a couple things. Number one, they know that he is going to get us back on a growth path, just as he did before, because, and here's the thing, I want to kind of preface this with this. Whether you're in the Trump camp or not, and you're listening to this, there are a few things that we can talk about that are absolutely so. My wife has recently been on a journey to lose some weight here, and she's done very well. She's doing very well. But one of the things that she said to me the other day that really resonated with me is this. And she said, it's not the things that you know that get you in trouble. It's the things that you think you know that just ain't so. That get you in trouble. And so here's what I would say about that. We do know what Donald Trump will do if he gets elected. We know that he will regulate the border. Right. He will deregulate business. He will cut corporate taxes. and he will put America back on a growth path. Just simple. He will. And people are going to love that because business, as you deregulate and as you cut their taxes, that's good things for business, that's good things for the stock market, and that's good things for the general public in general. So with that being said, is it going to drive inflation higher? So let's talk about that. I mean, we had, 3.7% growth in GDP the last couple of years that Trump was in office, and we still had below 2% on the inflation scale. So what created the inflation was just the fact that we shut the government down. We printed a bunch of money. I know this is old news. We printed a bunch of money, and we put it in the system. And the old saying is, it doesn't just flow through the system one time, it flows through 7 times.
I mean, at least we beat Medicare, though, printing all that money.
I saw that clip, we beat Medicare. What does that even mean? Do you know, or do you think even the president knows?
Just for those who didn't watch the debate, there was a segment during the debate. Joe Biden got pretty froze up and took about 25 seconds, and then finally ended with, "Well, we beat Medicare." So anyway, I was just joking about that. However, all this entitlement spending does have to come from somewhere. Right. And if you just simply print the money, that doesn't mean that it just came from nowhere. That means that it comes from somewhere in the form of inflation. And so it is entirely possible to have the economy growing and have inflation, or prices in general, under control. And Donald Trump did do that. Again, love him or hate him, his antics, whatever it may be.
Right.
He did do that from 2016 to 2019 and even in the beginning of 2020.
I think one of the things that needs to happen, and I think this would happen, right now, everything is the government mandate. We're mandating wages. We're mandating everything. And that's just not how America was built. In fact, the way America was built was to think outside the box, to be more productive, to figure things out, to be positive, to have a dream and chase it, right?
Right.
Not, I'm here, I'm breathing, so I deserve everything. And I just think that we're going to be able to turn that corner, and I think we'll be able to have a good growing economy. I don't think that inflation will continue to be a problem unless we continue to spend more money than we need to on entitlements. I mean, at some point, everybody has to pull their own weight. My dad used to say, Randy, you got to get up and go to work.
That's right.
You got to go to work. If you want that new car, you got to go to work. If you want that new, for me, the first thing was, you want a stereo. How much is it? Well, you're going to have to go to work for that, boy.
Well,
It's kind of what I remember back in the day. And, so I think we've got a good chance at a really good economy, and I think we can keep inflation under control.
I think it's also important to realize that there are basically 2 types of inflationary environments, right? There's the inflation that we've been having the last few years, where we basically have the economy sputtering and prices are still going up. And by and large, there's a lot of places in the economy that are struggling. But then you have the 1980s style inflation, right, where you have actual growth driving the inflation in prices. And while we do need to correct it, it's a very different animal when you have the growth to back it up. And I think that looking forward, who the next president is will determine how much inflation is, but also what type of inflation we have. Do we have empty economic inflation, or do we have inflation driven partly by a very strong economy, in which case we can afford a little more inflation than we can if the economy is just kind of lackluster?
We're talking with Randy and Jake Floyd of Floyd Financial Group, and we're talking about the Trump victory possibly causing inflation. I just saw that a poll, now this is from a New Zealand traders group, that said that now Donald Trump has about a 58% chance of winning versus a 31% likelihood of Biden's victory. If Joe Biden is not going to be the candidate for the Democrats, who then could it be at this late stage of the game?
Well, there's been a lot of people floated out there. One is Michelle Obama. The other one's Gavin Newsom, and along with Hillary Clinton.
Okay.
That's a couple of things that I have heard and read about out there. And then there's 2 or 3 other ones that don't come to mind right now that I did read in that same article. People that are not as well known as those that I just mentioned. But, I could not imagine that anybody could think that California is a successful experiment in government under Newsom.
Yeah.
I mean,
as a former Californian, I mean, yeah, that's been pretty much a disaster. I've seen Kamala Harris, I've seen Robert Kennedy Jr., but this is so late in the game. It makes me wonder, have we really seen the truth about what's going on in the presidency? I mean, it seems like the president has been... I remember back, and how can I put this? Was it Roosevelt who was in a wheelchair, but he was never photographed with the wheelchair? Is it the same way with Biden, is that there's been a problem there, but they've hid it from us?
yeah, I think that there has been a problem there for quite some time. Some people in the healthcare profession that I know have said that they had seen classic signs
Right.
of Alzheimer's. And so, I don't know. I'm not a medical doctor or a psychiatrist or anything like that. I don't know, but I do know that during that debate, and it's been resounding around the world, he's not fit to continue.
And even as a layperson, I could see from that, too, that this is somebody who clearly has problems. And it's, I'm not going to slam Joe Biden for having Alzheimer's or dementia or signs of that because it happens to a lot of people. It's just that this may be the most important job in the world. And you really want somebody who's fit, I think, mentally to be able to do that. And I think even almost physically as well, too, because it's so demanding. So anyway, we shall see what we shall see. Do you think that there's another debate in the works here? And if there is, who's going to be standing up there for the Democrats?
Yeah, I could not imagine that they would have a second debate at this point.
No.
I haven't heard anything about it, but I just could not imagine that would be something.
Yeah, I would say that if they're going to do it, they better get on it because, it's not long till the Democratic convention. I mean,
Yeah.
they realistically have probably 30 to 40 days to figure this out because after that, they need to have it lined out so they can set everything up for the convention. A couple of people we didn't mention that are out here, I've seen Gretchen Whitmer, who's the Michigan governor. I've seen her several times on other sites and things, people floating her name. I think that's maybe a way they can cop out and not have to replace the black Asian female with a slick-haired white male.
Right.
They don't want to do that if they can avoid it. Governor Josh Shapiro of Pennsylvania is also another name they've floated a few times. I don't think we're probably going to see a debate. I think, ultimately, and this may be controversial, I think former President Obama is probably going to basically have his say as to who this is going to be, and we're all going to find out after the fact. I really think that the debate was kind of a hit job on Joe Biden. All the news outlets the day after were all saying almost the same thing verbatim, which means they'd been fed what was going to happen. We saw that Joe Biden was capable under some sort of influence, frankly, but capable during the State of the Union address of holding his composure and forming a sentence.
Right.
And they clearly did not do whatever they did with him that day during the debate, which they could have, which means they hung him out to dry, knowing this was coming. And so I think, again, I've said many times on the show, I didn't think Joe Biden was going to be the nominee. Now it's starting to look like I actually might be right, but we'll see. But I do think that they're going to have to figure this out in the next really 4 weeks.
And when we began this segment, I talked about the headline that I'm reading right now that says a Trump victory could fuel more inflation. Well, the second part of the headline is what investors can do now to protect themselves. So I'll throw that back over to you. What can investors do now to protect themselves?
If we really start to see inflation, if you look at periods of high inflation throughout history, it has paid to be in the stock market during those types of periods. So if you look back at the 80s, what people remember about the 80s is that interest rates were very high. There was times where you could get 12, 15, even 18% briefly on CDs, treasuries, those types of things. But here's the thing to remember about that. Even though those interest rates were high, while the interest rates were 12, the market was returning 24, 25, right? And even during this last bout of inflation, while inflation was running, the market is up a lot over that period. And so if we're going to have a period of prolonged inflation, I'm not saying that Donald Trump would bring that. I'm just simply saying if we are to have more inflation, you're going to want to have some money at least tied to the stock market. It doesn't have to be in the stock market, but I would tie it to the market because the market has a remarkable way of floating on top of inflation because of the way the value of a stock is derived. If we have increase in prices, we have increase in profits, which in turn creates an increase in stock prices. And so as that happens, you tend to ride the wave of inflation instead of getting crushed by it.
What are you hearing from your clients insofar as inflation goes and how to get through this? I mean, is it the same thing where they're just worried about inflation? What are they telling you and what are you telling them?
You know, people are definitely feeling the sting of higher prices. I would say this, though, that most of my retirees, and you know, we have some very wealthy clients and we have some clients that are not so wealthy that, you know, they worked a job, they saved their money and they did well, they're doing fine in retirement, but they don't, you know, have $200,000 or $300,000 a year in retirement income. In fact, we know across the country, probably the average retirement income is somewhere, I mean, with both mom and dad and pensions and everything that they might have, you know, Social Security and 401ks, is probably around the $60,000 a year mark. In fact, I read just the other day that the average American couple 65 is spending $4,800 a month. It's what they're spending to live right now. Now, we have people here that are able to live on $2,500 a month and do quite well. And then we have other people that can't live on $20,000 a month.
Yeah.
You know, and so
It's kind of like the government.
yeah, exactly. It's one of those things that everybody has a different idea about what retirement is and what it should look like, and again, how you want to live. But I think for the most part, when people come in to see us for their annual review or their or we have some people we meet quarterly, some people we meet every 6 months, some it's a year. People they're doing okay, but they're looking to us to kind of give them some guidance as to where we think things are going and kind of what to expect, you know. And their concerns are everything from, you know, is Social Security going to go under? What are we going to do with all this national debt? You know, what is the stock market going to do? Is our currency, you know, in America in trouble? And we're going to address that here a little bit later, that it's absolutely not, but we'll talk more about that. You know, those are the things that people are concerned about. And you know, am I okay to keep spending what I'm spending? And in some cases, you know, people say, well, I might need a little bit of a raise from where we were. But for the most part, people are doing okay. And, you know, the market has rallied pretty well. Like Jake said, over the last 9 months especially, the market's up quite a lot. And for people that have been invested, they've reaped those rewards through there. So for the most part, people are a little nervous, but generally when we get them in here, we sit them down and we kind of talk about where things are. You know, the media has to make things scary,
Right.
sensational, or it doesn't sell. So, in fact, many times I read articles and I look at the headline, and when I read the article, it's the exact inverse of what the headline was when you get underneath it. But they got to get people's attention. And sometimes they don't give any solutions, they just kind of scare people. And so we're here to say, hey, look, there's a way. Yes, once in a while we get dealt some lemons, but here's how we make the best lemonade. And here's how we're going to solve this issue looking forward, and you're going to be fine.
And always remember this, we beat Medicare. And those are words to live by, okay? Talking with Randy and Jake of Floyd Financial Group. Again, if you're enjoying the program today, if you'd like to get in and sit down with Randy and Jake, have a one-on-one conversation, just a conversational analysis about your journey towards a confident retirement, we're offering you that opportunity right now by having you call 417-889-7233. 417-889-7233. That is a telephone number to request your Floyd Financial Group financial review. No cost, no obligation, certainly no judgment. Make that call this weekend. Leave your name and telephone number. Lovely Ashley will call you back during the week and set up a time for you to do that. It's a no-tie zone. Very, very casual. Don't bring your checkbook, of course, because there is no cost to this. 417-889-7233. You can also request your appointment or find out more about us online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. Time for a break, gentlemen. When we come back, we'll be talking about the dollar getting the extra boost when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to talk about the U.S. dollar, productivity, and what all this means.
Right, and I've got a headline in front of me again that says the dollar gets extra boost as Supreme Court ruling signals U.S. currency has room to run. Okay, let's sort of digest this and really figure out what this is all about. So what is this headline really pointing to?
Well, basically, I think what it's really pointing to is the fact that regardless of what anybody says, and we've got this thing called the BRICS currency, that alliance that it was Brazil, Russia, India, China, South Africa. Now it's some other people have joined on out there. Everybody was trying to dethrone the dollar and tell us how they're going to just take everything over, and they make it look really good. If you read the headlines and stuff out there, just every little bit you see BRICS. They had a meeting here, they had a summit there, they had this here, and they'll put something out there that sounds really huge and astounding to the general public, and that is $749 billion was traded between Russia and China and left the dollar out. Well, first of all, $749 billion is about 1 hour of a day's business, or maybe even 15 minutes of what goes on around the globe. So it's really nothing, but it sounds huge. And so there's been a lot of people, in fact, this is one of the concerns that a lot of people have when they come in to see us is, hey, what's going on? Is this BRICS currency really going to, take things over? And the long and the short of it is right now, there's still like 60% of every transaction on the globe is still done in the U.S. dollar. And it hasn't changed that much in many, many years. And the reason is, Jeff, let's face it, if you were going to bet on an economy and you wanted to hang your hat in the most stable place possible, even though sometimes we have stability issues ourselves, I have to agree, where would you go? Would you be ready to go to South Africa and hang your hat on South Africa?
No.
Or would you rather do it on the U.S.? Or how about this? Do you think that President Xi over there is going to have your best interest, so you want to do all your business in China, in Chinese yuan? What do you want to do? I just think that they're trying to do something here that's not going to happen for probably many decades.
I'm looking further in this headline here, and according to Jane Foley, who's the head of the currency strategy at Rabobank in London, she says if Trump pushes ahead with some of his huge tariffs, that is inflationary. That could mean that the Federal Reserve's rate-cutting cycle comes to a halt very fast and would be dollar supportive.
It would be true. Also, the inflationary side of that depends on what is actually done with the tariff dollars. So many times you could actually use the tariff dollars that are collected. Number one, the tariff does two things. It slows down the import of goods outside the country, which props up jobs and things for us here. But secondly, that money that's collected when it comes in can be used to offset national debt, taxes, all sorts of things. So there's a possibility of that, but I think that, we've seen before when Trump put the tariffs in on China, we didn't really see inflationary pressure here because of that. We saw it because we printed an additional 40% of American money that we'd never seen before.
Yeah, I also think, too, Randy, that we're seeing these central bank heads start to shift towards something that you and I have been talking about for a long time, which is how are we going to tackle this debt? We're refinancing all this debt at 4% and 5% interest. How and when are we going to shift back and try to figure out a way to, since we're clearly not going to pay it off, by actually reining in spending like a responsible country, if we're not going to do that, we have to figure out a way to refinance this debt at something less than 4 or 5%, because we've been used to paying interest of around 1% on this debt, and now it's all getting refinanced higher. So the debt service on our debt has gone from about $300 billion to $1.1 trillion even, over the last couple of years because of all this inflation, because we've been forced to refinance the debt at current interest rates. So you're starting to see, not only Powell, but I think we're starting to see Japan really positioned to kind of inflate away their debt as well. People are like, why doesn't Japan do something about their currency that's in free fall? It's because it's probably by design so that they can deal with some of this debt they created over the last 40 years. And so I think we're going to see a lot of central banks start to shift that way. So I think that's why we're probably not going to see the dollar go up a lot, but we're also probably not going to see it go down a lot, in my opinion.
We're talking with Randy and Jake Floyd of Floyd Financial Group, and we're talking about the strength of the dollar, and we're talking about the national debt. Of course, the national debt continues to go up. As you said, we keep kicking the can down the road trying to refinance this. What do you think is the end game? What needs to happen in order to get the debt under control? And when that happens, what effect is that going to have on us as consumers and investors?
Yeah, we need to have some fiscal responsibility at the government level. And we may be starting to see some of that. There's two ways to solve a debt crisis. That is, one is to grow out of it, and the other is to reduce your spending, right? So
yeah, sure.
I remember when I got married to my wife back in the 80s, we were not making very much money, and we were racking up debt. We were buying houses, we were buying cars, we were, we had kids, we were raising kids, all those things. But then over time, as we became more fiscally responsible and we made more money, we were able to pay off all that debt and finally get to the point to where, we had a situation to retire and all that, right? But I think it's the same way here. The first thing that has to happen is, number one, we've got to have some fiscal responsibility. Number two, we've got to make sure that we're doing all we can to grow an economy and boost productivity. It seems to me in a lot of cases today, people are trying to figure out how they can do less, not more.
That's right.
And the bottom line is, if the farmer never goes out and plants a crop, guess what? He's not going to get to reap a harvest, and we're not going to get to eat the harvest that he's reaping, right? So we're going to starve to death. The long and the short of it is, productivity is key. And we are right now the most productive nation really of any size out there.
So we're a very productive nation, but yet we have all of this debt. And I know we talked about this off the air. It may be a very difficult question to answer, Randy, but you and I have been around a long time. I'm not going to say that long, but we've been around for a while here. We've got a few miles on our odometers. How did we get here?
Jeff, I think we'll have to reach out to the next show and the next show and the next show and make sure it's
Right.
okay that we go over our time here.
That's right. We need a little more time than we have left here, but let's just give it a try here and maybe do the Reader's Digest version of this, encapsulated a little bit. How did we get here?
Basically, Jeff, and there'll be people listening to the show that will disagree with me, and that's perfectly fine. I will tell you that it's the nature of mankind in general to regress, not progress. And so when we are lining up, giving out entitlements, and wanting everybody to live at the same level as your wealthiest friend down the road,
Regardless of how much work you put in.
that's right, regardless of how long you've worked and what your age is, it just doesn't work that way. It takes time to build equity in things. It takes time to build a business. It takes time to build a reputation. It takes time for people to learn what they need to learn to earn more money. This idea that everybody should have a minimum wage of $50 an hour so that they can live just doesn't work, because there are some jobs that do not warrant $50 an hour. And so we have to look at this productivity chart again. And I know I could keep going back to that, but economies are based on productivity. Again, if the farmer doesn't farm, we have no food, and so you'll have to go out and grow it in your backyard. If we don't make goods and services to be sold that help people and create opportunity for people, then, we're not going to get paid.
I do think Randy is 100% correct there. A couple of notes I would add on that, though. I think it's important to understand that we're not saying that the ship is sinking. So just because I don't think we'll ever get out from under this debt, and the debt will probably never get actually better, meaning we're never going to run a surplus and have a bunch of cash on hand in this country. I mean, I would be willing to bet quite a lot of money on that. But what I would say is that we just need to get used to this environment that we're in, use it to our advantage, and get ready to live life. We can't wait around for things to get better. We have to make lemonade with the lemons that we have now. And I really don't think it's going to be all that bad either. However, I don't think that anybody is going to magically all of a sudden become responsible and stop spending. The amount of spending cuts that would be necessary to even just get to where we have a deficit surplus, where the debt actually starts going down, is just astronomical. And the quote-unquote mandatory spending in this country is more than that. Not the frivolous crap that you and I read about, but even just defense spending to Social Security and that kind of thing far and away is over where the neutral level of the deficit is, or the spending. So I think we need to get used to it here. It's okay here. The water is not perfect, but we'll use it to our advantage. And, I think people that are nearing or in retirement need to get ready for a great retirement.
All right, so take some fiscal responsibility for your own retirement. And, I think about something that you just said there, Randy, about when you and Lisa first started out in life and the struggles that you had. And I've talked to other financial advisors who do quite well, and I've heard that people say to them, well, you're so lucky because you have this practice and you're doing very well. Well, luck didn't really have a lot to do with it, Randy. I think it had to do with maybe some hard work.
Right. When, I was, I guess, not as smart as the average bear because, I left my corporate America job cold turkey and started this company from zero. A lot of guys will go to work at Edward Jones or somebody like that to kind of cut their eye teeth, but no, I left my corporate job, which was a pretty good job. It was just ready for me I was ready to do something different, so I didn't know what it was at the time exactly, but I figured it out. And so we started going to school and started learning and started seeing clients. And, here we are nearly 25 years later, but it wasn't all just easy going there. There was a million miles of driving. There was late nights that I didn't sleep well, early on when we're trying to figure out how to make this thing work,
Sure.
But over time, with consistent effort, you can succeed. And that's one of the things that bothers me is sometimes I read where the Gen Zers feel like they can't succeed, that there's no opportunity left in America. And I got to tell you, there's nothing further from the truth. In fact, if you think about it, the more problems people have, the more the opportunity to find solutions to solve those problems. And that's how big and successful businesses are created.
Right. It's determination. It's perseverance. I mean, like I said, I know one financial advisor who built his business, and he said, I slept like a baby every night doing this. He said, I woke up crying and gnashing my teeth about for 2 hours, like babies do, and trying to figure out how I'm going to make payroll and all of that. But he just kept going and he kept learning and he just kept pushing ahead and finding ways to do something rather than making excuses for why I can't do it. So I think that applies to financial planning. And it applies to life in general. Find out how you can do something. Don't give me a reason why you can't do something. We're talking with Randy and Jake at Floyd Financial Group. It's the show that makes sense. These guys make sense to me. I hope that they make sense to you. If that is the case, and you want to sit down and talk to somebody with their sort of mindset, we're offering an opportunity for you to do just that by calling this number, 417-889-7233. 417-889-7233 and request your complimentary, no cost, no obligation, no judgment financial review with Randy and Jake at Floyd Financial Group. Make that call this weekend. Phone lines are open right now. Leave your name and telephone number. Ashley will call you back during the week and find an appropriate time for you to come in and sit down with Randy and Jake. Again, doesn't cost you anything, no obligation. 417-889-7233. You can also request your appointment and find out more about us online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. We're going to take another break. When we come back here on Show Me the Money, we'll be talking about the 90s-style internet bubble, how that might apply to AI and more, when our show continues after this on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpas, Randy and Jake Floyd.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about, there's been stuff in the headlines, Jeff, that says this is very reminiscent of the late 90s and 2000 during the dot-com bubble.
And I remember the dot-com bubble. The dot-coms became dot-bombs, but back in those days, they really did. If you just took any name and put a dot-com on the end of it, you didn't have to have a product, a service. You didn't have to do anything. People would invest in that. And of course, that just, those investments went belly up. Today, with artificial intelligence, do you think that really has any similarity whatsoever to what happened when the dot-coms first came onto the horizon?
Well, I think that there's a vast difference on several fronts, but the biggest difference I would say is, technology in the 80s and 90s was something that was, it was new. It was this virtual reality, we called it, and that we live in today a lot of the time, anymore, we're looking at a computer screen, we're looking at a virtual piece of paper, not a piece of paper in front of us that we wrote it down on, right? So it's a different time, and technology now is a huge portion, right around 30% of the overall stock market. And I think people need to understand that when we say the stock market, it's 30% of overall business that is technology. So it's not just the stock market, that nebulous thing that we talk about out there. It's basically that, 1 in 3 people roughly has something to do with technology and the internet and software and hardware that makes all that possible. And so when we look at that, and we're looking at these companies like NVIDIA and Microsoft and AWS, which is Amazon's web services company, when we look at Google and what they're doing and ChatGPT and all those sorts of things, number one, these are not fledgling companies that are doing all this stuff. These are huge companies that are taking technology to the next level. And that's where it's going to go. Now, do I love all that I know about AI and what I think it's going to bring? Probably not. In fact, it scares me a little bit. But here's what we do know. It's here to stay, and these companies are not going out of business, and they're not in any type of a real debt issue. Now, certainly we got small companies out there that are startups and things that will be sucked up by these larger companies most likely, and there are some that will go by the wayside. But here at Floyd Financial Group, we are about retirees and their safety and their security for income. So we're going to let other people invest in those things, and as they come up and become mainstream, we may invest in those. But this is not a dot-com bubble. We got some comparisons here we'll talk about in a minute that will, I think, make people see that.
Well, back in the 90s with the dot-coms, I mean, there were literally probably thousands, if not tens of thousands of people in this dot-com arena. With artificial intelligence, basically, how many players are there?
I'd have to count up. There's a lot, obviously, but I don't know what the main, maybe 10 are the main ones really pushing things, wouldn't you say, Jake?
Kind of depends on how you define AI players. So we have the hardware side of things, we have the software side of things, and then we have the actual AI brain side of things. There's a lot of companies around AI. I mean, there's hundreds at this point. But I would say that they're the main players. Yeah, Randy's right. Probably about a dozen companies or so. I think one of the main things that comes to mind for me when we're talking about a bubble or what's, euphoria in a market or overexuberance, if you will. Usually what we're talking about is a place where everybody thinks that things are going to go up forever and never come down, and it's never going to be bad again, and so on and so forth. Well, I don't know about you, but I don't think when I turn the news on or I hear any of the talking heads talk or radio shows or anything, I don't feel like everybody is positive.
I would agree completely. Still, there are a lot of people who are doubters. I don't blame them. There's plenty of reason to doubt things. But yeah, I would agree with you completely.
But doubters are fuel for markets and asset prices, right? Because that's somebody that can be converted from a non-believer to a believer and then therefore buy in, which drives prices higher. So typically when you're at a top, nobody is expecting it to be the top. In fact, if you remember in 1999, 2000, the exuberance was definitely irrational around that time. And we had hundreds of companies that were IPOing that weren't even companies. We talked a little bit about this last week. But you have hundreds of companies coming out on the New York Stock Exchange that didn't even have any companies. They just had an empty building, and they said, hey, we're going to be this great internet company. Give us $1 billion, And so these companies went public, and they cashed in, and then they folded up shop. And because everybody was so sure that the internet was going to change everything forever and make it go straight up forever, they didn't even bother doing any homework. That's what the dot-com bubble looked like. So right now, again, I don't think this fits that bill from a number of standpoints, but probably the most important one is there's too many top callers out there in the market right now, meaning everybody's saying, this is it, this is the top. You need to run for safety. You need to be careful here. You need to be careful. You need to be safe, and you need to not do this. And if you turn on the news, you just hear that all day. There's very few people saying, hey, I think this thing's going to go, it's going to keep going, and it's going to defy everybody's expectations. So usually when the market is very negative, the people are negative, that means the market still has room to go. Now, I'm not saying we can't have a correction. We're overdue for correction. Anybody that talks to me will know that I think that. But I think that the 6-month, 12-month, 36-month, 60-month outlook is higher, not lower.
You said that during the dot-com bubble there, the dot-com era, that a lot of people didn't do their homework. Investors didn't necessarily do their homework. I think we've established that artificial intelligence has a few more legs than some of these phantom companies that popped up during the dot-com bubble. So how do we do our homework? How do we vet artificial intelligence companies?
Well, I'd say the average person probably doesn't do a whole lot of that, right? So a lot of the reason people hire us to help manage money is because that's my job, is to go through and vet these companies, make sure we understand what we're investing in, the profit potential, what they're charging for their products, the demand for their products, growth levels of these companies. It's also important to understand, too, we're not only investing in AI companies. I want to make sure that that's clear because, as Randy said before, the return of your money is more important than the return on your money. And while we can sit here all day and prognosticate about what we think is coming, the reality is nobody really knows what's coming. And there are exogenous shocks that can happen to us at any time. And so it's our best guess. However, if you do not invest, you will not make any money. And so we have to not panic about every little thing that comes down the pike, because what you'll end up doing for the most part is just costing yourself money, not saving yourself money.
We're talking with Randy and Jake, Floyd Financial Group. We're talking about the internet bubble of the late 90s, early 2000s versus artificial intelligence. Earlier, Randy, you talked about comparisons between the dot-com bubble and artificial intelligence today. Can you elaborate on that?
Sure. According to Bloomberg and NASDAQ, of course, the NASDAQ is where a lot of the technology companies are, where they all trade. And the NASDAQ 100 is what we measure and look at a lot. So at night, you have the S&P 500, which is roughly 500 to 510 of America's largest companies. You got the Dow, which is 30, and then you got the NASDAQ 100. And all of those, there's a little bit of the NASDAQ and the S&P and the Dow, and there's obviously the NASDAQ and the Dow in the S&P. So all those kind of bleed over a little bit. A lot of times people will know these as the Qs, is what they are today. A company called Invesco basically said, hey, these are the NASDAQ 100 companies, and that's how we can invest here. If we look back over our shoulder, according to Bloomberg and NASDAQ, they said that the price-earnings ratio, now let's talk about what that is. When you look at a price-earnings ratio, let's say that I have a company that basically the stock price is $100. The company's able to make a profit of $5 or 5%. So you divide that into 100, you have a price earnings ratio of 20. And somewhere between 16 and 20 is generally what would really be considered a good sweet spot. Now, there's other companies where you'll find a lower price earnings ratio, which means they're more profitable, but many times those companies don't have much upside. So we have to really start to balance and figure out where we need to be with companies. But I want to say this, in 1999 and 2000, the price earnings ratio of the NASDAQ was 175, which basically means those companies were making no money. Mm-hmm. Today, 31.47, as of I think it was just a couple of days ago. I can't remember the exact date. Maybe it's 28th of June. 31.47. So the bubble effect, if you will, is basically less than one-fifth what it was in 2000. So are we in a huge bubble? I mean, has there been some speculation? Yes. Is there sense in the valuation of these companies and where they're going and the ability to make money? Yes, there is.
Randy and Jake, if our listeners have questions about artificial intelligence and how it compares to the internet bubble of the late 90s and 2000s, again, I want to invite you to give us a call here at Floyd Financial Group so you can get those questions answered. Randy and Jake are standing by to talk to you. So many people say, well, I don't have anybody to talk to about finances. Well, that's not the case right here in Springfield, Missouri, because Floyd Financial Group is standing by, and we really do want to have a conversation with you. Again, this is simply a casual conversation. It's a no-tie zone. So if you're looking for answers, give us a call here at Floyd Financial Group and come and sit down and have that conversation. You can get the conversation started by calling 417-889-7233, 417-889-7233. It is the weekend. It is a holiday weekend, but our phone lines are open, so make that call right now. 417-889-7233. Leave your name and telephone number. Ashley will call you back during the week and set up an appointment for you. It'll take about a half hour to an hour or so to get this conversation started. But again, it could be the most important phone call that you'll make all year. Get your second half of the year started off right by calling 417-889-7233 and talking to Randy and Jake. You can also find out more about us online at FloydFinancialGroup.com. It's FloydFinancialGroup.com. Well, Randy and Jake, we just get started, then the clock says it's time to go. So for Randy and Jake, I'm Jeff Shade. Have yourself a great holiday weekend. Stay safe. We'll look forward to talking to you again next week with another edition of Show Me the Money right here on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and are not intended as investment advice for any individual or entity. All information contained herein believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning offered through Floyd Financial Group, LLC, an investment advisor registered